Today, we're tackling one of the most critical topics in auditing: going concern considerations during audit planning. Why is this so important? Because if an auditor or management misses the signs that a company may not survive the next 12 months, the financial statements could be misleading, and users, like investors, creditors, or regulators, could make very bad decisions. In this video, we'll break down what going concern means, management's responsibilities, auditors' responsibilities, red flag indicators, real-world examples, and how these conclusions affect the audit report. And before we dive in, don't forget to hit like and subscribe to Canada Accounting Insights for more practical breakdowns of IFRS ASPE taxation and assurance concepts. Let's jump in. First, let's define it clearly. Under the going concern basis of accounting, we assume that an entity will continue operating in the foreseeable future. That means it won't liquidate or significantly scale back its operations. General-purpose financial statements are prepared on this basis, unless management either intends to cease operations or has no realistic alternative. In auditing, the key standard here is CAS 570, going concern, which guides auditors on their responsibilities and the impact on the auditor's report. Now that we know what it means, let's talk about who is responsible for assessing it. Management is always the first line of defense. Under IAS 1 for public companies, management must perform at least a 12-month assessment of the company's ability to continue as a going concern. Under ASPE Section 1400, a similar requirement applies. This assessment requires judgment about future events, cash flows, financing options, debt covenants, and business risks. If the company is profitable and stable, management can quickly conclude that going concern is valid. But if warning signs appear, they must document their assumptions, support those assumptions, and disclose risks if necessary. So what kind of warning signs should we as auditors be looking for? Let's go through the red flags. CAS 570 provides a list of indicators. Think of them as red flags. Financial indicators: net liability or net current liability position, adverse financial ratios, debt maturing soon without repayment or refinancing options, reliance on short-term financing, negative operating cash flows, substantial operating losses. Operating indicators: loss of key customers or suppliers, labor difficulties, loss of licenses, departure of key management, declining market share. Other indicators: lawsuits the entity can't afford to settle if it loses, changes in laws or regulations that harm the business, catastrophes like uninsured disasters. For example, Electronic Ink borrowed heavily to finance new technology. The product flopped, sales dropped, and the company started losing money. It was on the edge of breaching its debt covenant. Suddenly, a company that was once profitable now faces major doubt about its ability to continue. Once those warning signs are present, it's time for the auditor to step in. The auditor's job is to evaluate management's assessment and conclude whether the going concern basis is appropriate. CAS 570 outlines three main objectives for auditors. 1. Obtain sufficient audit evidence on the appropriateness of management's use of the going concern basis. 2. Conclude whether a material uncertainty exists. And 3. Determine the implications for the audit report. That means we don't just accept management's word. We test their assumptions, cash flow forecasts, and financing plans. But how do auditors actually perform this evaluation? Let's break down the process. Here's the step-by-step approach. Step 1. Obtain management's assessment of going concern. Step 2. If it's less than 12 months, request that it be extended. Step 3. Evaluate for reasonableness. Compare projected sales to historical trends, check repayment schedules against loan agreements, and challenge assumptions. Step 4. Perform additional audit procedures if risks exist. Some key procedures include analyzing interim financial statements, reviewing debt agreements for breaches, reading board minutes for financing difficulties, consulting legal counsel about lawsuits, confirming availability of financing or financial support, checking subsequent events that may affect survival. For example, Beauty Co., a cosmetics company, had $5 million in milestone payments due with only $500,000 in cash. Management claimed new financing was on the way. As auditors, we would request proof of loan agreements, assess if they are firm commitments, and evaluate whether the new financing actually covers the obligations. So, once all this work is done, how does it affect the audit conclusion? At the end of the day, auditors must decide between three possible outcomes. Going concern is appropriate with no material uncertainty. Issue an unmodified opinion. Going concern is appropriate, but a material uncertainty exists. If disclosures are adequate, issue an unmodified opinion with a section called Material Uncertainty Related to Going Concern. If disclosures are inadequate, issue a qualified or adverse opinion. Going concern basis is not appropriate. Financial statements must be prepared on a liquidation basis. If disclosures are adequate, the auditor may still give an unmodified opinion, but often with an emphasis of matter paragraph. If disclosures are inadequate, the auditor issues an adverse opinion. For example, Burger Bomb, a fast food chain, disclosed a material uncertainty due to a food contamination scandal and falling sales. The auditor agreed the disclosure was adequate. The result? An unmodified opinion with a material uncertainty paragraph drawing attention to the disclosure. So to wrap this up, let's summarize the key takeaways. Here's what you should remember. Management is responsible for assessing going concern and documenting assumptions. Auditors must critically evaluate this assessment, perform additional procedures, and remain alert for red flags. Red flags can be financial, like liquidity issues, operational, like losing customers, or external, like lawsuits. Audit reports vary depending on whether going concern is appropriate, uncertain, or not appropriate. Going concern isn't just a technical requirement, it's a critical safeguard for stakeholders relying on financial statements. Thanks for watching this breakdown of going concern considerations in audit planning. If this video helps simplify the topic, make sure to give it a thumbs up, subscribe, and share it with someone else preparing for their CPA exams or working in assurance. Until next time, keep learning, keep practicing, and I'll see you in the next video.